Welcome back. We investors have lived through a couple of turbulent months with the market down dramatically and then rebounding in recent times. So how is fund manager Ben Griffiths planning to play the market going forward? And Ben joins me at the desk. How are you, Ben?
Peter, well, thanks.
Now, mate, did you rub your hands when the market fell and just dived in buying all the stocks that you liked?
Well, that's what we normally do. We do try and buy the lows and sell the highs. But what else would you expect? What else did you expect me to say? Look, I think our inclination to do that is premised on the fact we are equity bulls. We like the international equity backdrop. We think stock markets move higher over the short to medium term. That's a great backdrop for our market. The sell-off that we did see, largely driven in the US by a lot of those momentum stocks that got hit fairly hard. And of course a little bit of currency as well, which complicated things locally. We were certainly dusting off the folder and buying stocks that we've been trying to buy at the right levels. Yeah. But we weren't in any way dissuaded by what we saw. As you say, it was a buy the dip situation, and I think the market will stay that way. If the volatility continues, then it'll be a buy the dips mentality. We think that'll pay dividends. Yeah.
I was just looking at CBA. It got as low as 74.37, 8.7% a month with a quality company like that. It's not hard to make money when that sort of stuff's around.
It's one of those things. There's an old maxim that says when the time comes to buy, sometimes you don't want to. No. And like when that stock was down there, you had the currency under pressure. You had some international money basically departing our share market, and you had some international shorters deciding that the banks had run too far and Telstra had run too far. The yield story had been overplayed, but more importantly, there was the risk of capital damage, and it was time to exit those stocks. Now, that environment that was being whipped around, which saw CBA get down to those levels, that was a little unnerving for a while, and the brokers were starting to manoeuvre in terms of their "it's time to take profits on banks" call. So to then stand up there and go and buy the stock in the face of that, it was. You'd need to be seasoned to have to swing the bat hard.
Yeah, maybe I was drinking too much because I was telling people to do that. Anyway.
Yeah, well done.
So let's look at what you think is going to happen between now and Christmas, because the old Santa Claus rally is something that we expect. What do you think is going to happen?
Well, we're pretty bullish, as I mentioned before. The first important plank, of course, is the offshore backdrop. And US equity markets, having just completed a good quarterly reporting season, more or less, that's a great foundation for our market to want to go higher. I think locally, the risk to our market really is the currency. If the Australian dollar decides to leg down through 86 cents, that will unnerve some of our international investors, and that'll sweep our market lower. That's the only issue that I see, or the main issue I see, that can derail an equity rally into Christmas. Our market has successfully paid up for and bought growth stocks with zeal. And investors, especially professional investors, are targeting companies who have strong earnings per share profiles, strong, defendable, above average earnings growth forecast for this year. And when I say earnings growth, yes, there's some cost that can be cut out of many of Australian income statements, but it's all about companies that have got top-line growth, that hold out the very real prospects that they can grow revenues over over FY15 and into 16. They're the stocks that are going to continue to command investor attention. They're the sort of stocks that we want to own in our portfolio. Yeah. They're the stocks that we'll keep rating, and you'll keep hearing the calls that PEs are getting too full, they're a bit expensive. Yeah. Well, that's there's quite a bit of dispersion about high PE and low PE. It'll be the high PE stocks in the main that will continue to attract support, and it's going to be aggravating the Puritans who want to buy low PE and sell high PE. It'll be the high PE stocks that have got the matching growth that'll actually perform well.
And I guess Rams is a classic case of always been a high PE that a lot of Puritans said you can't buy it at that. And they couldn't do it at 16, they couldn't do it at 27, they couldn't do it at 50.
I know, that's exactly right. And like the stock that we've just put in the portfolio, we took it on IPO and we've been buying it on the dips, as you suggest, is Healthscope. Healthscope, also a private hospital operator.
You got some good news last week too.
Yeah, correct. It's on about 23 times, but on our modelling, it'll do about 23% in round numbers earnings per share growth. That sort of growth is the sort of growth that investors can touch and believe. Those sorts of stocks, so that sort of stock is a great example of a stock that will perform well. So we can own Healthscope. It's in our universe. Ramsay was one we used to own. Of course, it's now a very, very popular large cap. And of course, those that have bought Ramsay have we believe, gravitated down to Healthscope, saying, well, this is the up and coming Ramsay, if you will. So it's that sort of stock, Peter. Some of the aged care operators also who have got rather what appear to be full valuations, the Japaras of this world. We think that they've also got solid earnings per share growth coming. Solid top line growth actually is what the real driver of our interest in the stock is. It's going to grow top line.
Is that because you think, Ben, that there are people out there, baby boomers, who are actually going to be looking voluntarily even for an alternative to living totally independently?
Oh, no doubt about it. And it's also the fact that there is, to your point, there's an ageing population. The government will have a problem of how to accommodate and support and provide welfare for an aged population. It needs the private sector support. It needs the private sector to help do the heavy lifting when it comes to aged care provision. And that's exactly what Japara are doing. It's exactly what Regis and other aged care holding that we've got in the portfolio. It's that sort of dynamic, and there are several others, aged care operators coming to market. And that will be a hot space, again, because it's going to grow revenues. It's going to grow the top line, which will translate through to, we think, meaningful earnings per share growth. And they're the stocks investors are going to take comfort in. As you said before in your introduction to Mike Kendall, it's an uncertain market at the moment. There's an uncertain earnings picture out there. These are the stocks you've got to target.
When you look at the stocks that have done well over this year, they tend to be in the top 20, top 50. Then the 50s to 100s did well, but from 101 down to 300, apart from some standout ones, a lot of struggle. What do you think is going to change that? I figure, and I'm interested in your view, that history has told us that we generally passed the old all-time high, which in our case was 6.8. Even if we adjust it for the capital expansions, 6.3 even wouldn't be a bad number. Do you think we'll pass that before we go into another significant bear market? And if so, do we need these smaller stocks in the 100s to 300s to actually start getting enthusiastically bought by the market?
Well, we certainly do. I mean, if you're looking at the larger cap index, the ASX 100, I think to propel the market upwards towards the old highs, we've had the banks, and the banks are within cooee of the all-time highs. So the banks are performing well. There's a host of highly prized industrials that are also trading within cooee of all-time highs. We're going to need the resources part of the market really to chime in. That's about 18% of the ASX 100 is Woodside, BHP, Rio, Santos.
This is leaving mining services out?
Leaving mining services out. So you need that rump of the market also to chime in to propel it forward. But it's an interesting point you make, because the smaller end of the market has to some extent been looked over in favour of the big caps, the big cap banks.
Well, I feel guilty. I keep telling people buy stuff for dividends, but there are some small companies that pay reasonable dividends. I was going
through the sheet today, looking at what sort of yields are available in our neck of the woods, and there are any number of stocks that can give you between a 5 and 7% yield. Prime TV is one in our portfolio that has a prospective dividend yield approaching 8%. Now, whether they actually end up paying that dividend, I don't know.
But historically, they've been an over 5%.
They've been a solid 5% fully franked dividend payer. So there are a host of companies now in our neck of the woods, and the beauty of some of these stories is there's a dividend on offer there, a nice dividend on offer, which we think will be sustained. But there's also the prospect of some capital gains if you're buying the right story, right, with the right growth profile, and with a dividend kicker. It's a pretty attractive situation. So those sorts of stocks should be sought after by investors.
Right, Ben, thanks for joining us on the show.
Peter, my pleasure.
And maybe next time we get you back, we might talk about some of those smaller companies that have really good dividend profiles.
Be delighted to.
Thanks, mate. Thanks for joining us. Kerry Stokes of Seven West Media fame will go down in history as one of Australia's greatest entrepreneurs, and in his achievements they are chronicled in a new book called Kerry Stokes, The Boy from Nowhere, which underlines the magnitude of his achievements. To give us his insights after spending time with Mr Stokes and analysing his life, the book's author, Andrew Rule, joins us from our Melbourne studio. Andrew, thanks for joining us.
Thank you, Peter. It's a pleasure.
I've got to ask this question. Why did Kerry select you and say not me?
Well, I'm not sure of your form with writing, Peter, but I guess he wanted someone who could spin a yarn, and I've been able to do that over many years. I don't know a lot about business, but I don't think that's a problem when it comes to just telling a story. And it's really a rags to riches story, and in that sense it's a bit like a sports star or, you know, any other interesting person.
Yeah. You can see how jealous I was when I heard that you got the gig, mate. I saw the book called GST, Your Questions Answered, 130,000 sold, but it wasn't as interesting topic as Kerry Stokes.
I love those sales figures, Peter.
OK, mate, let's get down to it. So when you looked at the story, when did it start? With the book that you've written, when does the Kerry Stokes story start?
Look, it starts before his birth. It starts really in the Depression era, when the people who sort of produced him were growing up. He's the product of great poverty and hardship. His mother was a 20-year-old unmarried barmaid in Carlton, which was then a rough, tough suburb of Melbourne in those days. And she had this baby child at the start of World War II, and she put him up for adoption fairly quickly. And he was adopted by a very poor couple, and also from Carlton mostly. And he grew up around there and also at various country areas where his adoptive father used to work.
OK. Looking at his story, was he always going to be an entrepreneur?
I'd say so. I think he always had that urge. The self-improvement gene was in him. I think he felt the sting of poverty and of being considered inferior by perhaps other people. He hasn't really said that to me, but I'm sure that does have its place in somebody's mind and propels them to greater heights. I mean, we see this in other fields, don't we? You know, in sport, in writing. Henry Lawson was like that. Yep. He felt that sting and that propelled him on.
How did he go at school? And if he didn't do well, did that kind of make him sort of determined to prove himself in some other area?
I suspect so. And look, I think in your business, Peter, you've run against a lot of successful business people. You know, Lindsay Fox is one, but I can think of others who weren't big on school. So they didn't think school could teach them much. And these are all guys often not big on reading, but very big on, very good with numbers, very good at calculating the odds, very fast when it comes to, very nimble minds when it comes to money.
Yeah. I've also noticed a lot of radio personalities like John Laws and Doug Mulray left school because they didn't get along with their teachers. Let's go to his first business. His first business, Andrew. What was it?
Yep. Well, his first real jump into business was he talked his way into a job with a real estate agent in Perth. And he was an agent called Harold Seymour, who'd been a stock and station agent and was quite a decent, good bloke who taught Kerry Stokes quite a lot. One of the things he taught him was, he said, don't worry about the money you're going to make out of a deal, worry about giving good service to the people you're dealing with, and the money will look after itself. And that seems to be a life lesson that he's carried from that business onwards. After a couple of years, of course, he talked his way out of that job because he asked for a 5% share of the business, and the bloke said you can finish up on Friday. And so Kerry Stokes had to go out and hang his own shingle at the age of about 22 or 3, and he's never worked for a boss since.
OK. Did he have early failures that taught him important lessons?
He hasn't had a lot of failures. He told me once, he said, I was broke when I was 20, and a year later I was never broke again. So he has had the odd failure. He bought a big building in Dallas in the 80s that was an iconic building that cost him a lot of money in the end, but it wasn't going to cripple him.
OK. What about, was there an early breakthrough or like a eureka moment where he actually learnt so much from that particular event that it determined the way he did business going forward?
I don't know if there's any eureka moment so much as a string of probably good decisions. I think I've said somewhere that he's a bit like the fella that's gone into a two-up school and thrown, 7 heads out of 9 throws.
Yeah.
He hasn't had a lot of bad ones. I think there's been a couple of big wins though, and certainly when he got together lots of media properties in the mid 80s, and then sold them to Frank Lowy just before the crash of '87. That was a defining moment, and one he still thinks about.
Okay, so how did he get from real estate into a situation where he owns 7 and a whole lot of other media properties?
Well, he's shown a knack for being able to go from one business to another. He went out of real estate into building shopping centres. He became a shopping centre tycoon in the West with a couple of partners, one and then another partner, and then sold out just in time to sort of cash in at the right time, and got a lot of did a very good deal with the Commonwealth Superannuation Fund, which sort of cashed him up ready, so that when media properties came up, he was cashed up. He helped set up the first FM station in Perth, which was a runaway success, 96 FM. I don't think there's been a better start-up in the world than that one. He also managed to get the licence for the 3rd commercial television station in Perth, which took a lot of getting, and he had to sit through, I think, an inquiry that ran for 2 years or something, but he got it, and that gave him enough good property that when Lowy came knocking, he was able to sell out all this stuff at massive profits.
So that would have been 10 in those days?
Yeah, that was 10. Yeah, actually, yeah.
Okay,
yeah.
So, looking at his experience, it seems to me you're saying that he's got a very keen eye for what value is and when to get into the market and also when to get out.
That's been his defining thing. He sat me down once and he ran through all the, what he calls the major downturns, and he thinks he sort of picked them all ahead. And I think timing has been his big thing. He also said to me, he said, it's not about what you sell out for, it's buying right. You have to buy anything from a motorbike to a television station at the right money.
Yeah. Do you think he'll ever retire?
I doubt it. He's the last words of the book, and I don't want to spoil it, but the last words of the book say that he's making other plans.
Making other plans.
He's a guy he's making more plans. Yeah. He's always thinking. His son Ryan said to me, there's never a conversation that I have that anybody has with his father that it doesn't have business in it somewhere.
Yeah. Did you like him as a bloke?
I really do. I don't think I'm alone there. I think a lot of people do like him. A lot of the people who work for him obviously love him. When he turns up at their drinks after work in Perth on Friday nights, they all flock in there. They love talking to him. He's a bit like the premiership coach that, he's won 3 premierships and all the players love him forever, like Tommy Hafey. Yeah. He has that sort of persona. Great
stuff, mate. Look forward to reading the book when Christmas comes around.
It's an interesting story, and I really like him, and I hope that comes through in the book.
Yeah, I hope you sell 129,000 so you don't pass me, mate.
Yeah, just under you. That's where I want to be.
All right, buddy. Thanks for that. After the break, another pro gives us his view on how he's investing for the year ahead.